My guest today on the Alpha Exchange is Ben Hunt. He is the co-founder and CIO of Perciant, a new data analytics firm leveraging some really interesting technology in AI. Ben, it's great to have you as a guest on the podcast today.
Well, it's super to be here, Dean. Thanks for having me.
Well, I've known your name. We met many years ago, but I've certainly followed your work and your thinking over the years. So it's great to have an opportunity to host this conversation. We'll talk about some of what you're working on now in terms of your co-founding of Percient, but also really what I want to do is get into some of your thought process, which I find really helpful in helping people think about uncertainty, risk, market dynamics. So we'll have plenty to talk about. Give us a little bit of career history, just in terms of, you've got a background in academia, you've got a PhD, you made your way into markets 25 odd years ago. Just give us a little bit of that career trajectory.
Yeah, happy to, Dean. I've done a lot of different things. My wife tells me it's hard for me to keep a job, which I suppose is true. But so, I've really had, I think it's fair to say, 3 different careers. Now it's kind of full circle on a 4th. But I'll describe them to you. But the common thread through all of them is that I've always been trying to figure out the plot. I've always been trying to figure out what is the structure of unstructured data. What are the stories that we tell ourselves in politics, in markets, in life? What are the stories we tell ourselves? What's the story arc? And can we actually measure it? Because I'm convinced that the stories that we hear from other people, the stories we tell ourselves, that's what drives our behavior. We see the world through story, and we create a storyline to fit what we are seeing and experiencing. And that's true in investing for sure. It's true in the course of our lives. It's true at every level you want to think about it. So that's the common denominator. Now, how did I come to this, right? So I started as an academic. I was a political scientist of all oxymorons. And it really is an oxymoron. I mean, I feel that way about all the social sciences, particularly economics, the science of economics and the science of politics. Basically, it ain't. But that was my training, and I was very much trained in that world of game theory and econometrics and the like. So I got my PhD at Harvard. I was a professor at NYU, and then I got tenure spot down at SMU in Dallas. And that was my life, teaching for about 11 years. I love the research. I love the writing. I love the teaching. What I didn't love is the church of academia. And if anyone listening to this has ever experienced it, you know exactly what I mean. It's a church. So I always had the entrepreneurial bug. And so I left the tenured spot, moved back up to the Northeast. In 2000, we started our software company in March of 2000. So just as the NASDAQ bubble burst, we started our software company. But we did okay. We were very boring software, which was a good thing to be, because we actually did something. It wasn't a portal for this or that. If anyone remembers some of the excesses of pets.com and some of the NASDAQ bubble. But, I was a self-taught programmer, and we built a software company, ended up selling that. And I found that I really enjoyed the game of markets. And it is a game. It's the biggest game in the world, played by the smartest people in the world. And it's a rush. And I found that I enjoyed the private market side of that with building and selling the software company. So I did some venture capital, a little bit of private equity bird dogging there for a couple of years. And then joined a friend at a larger long only fund. He was starting a long short equity fund. This has been in 2005. And that was my baptism by fire. I had never done anything in public markets. And so it ended up being a good time to find Wall Street because I didn't come out of Wall Street. That's what I mean, right? So if you come into the business through, I'll call it the traditional venues of Wall Street, you come in. The informational flow, the story is always around buying. The story is always around buying. And that was fine in 2005 and 6 and 7, but it wasn't fine in 2008. So having an outsider's perspective allowed us to do well in 05, 06, and 07, and then really do well in 2008. Because I didn't come out of that culture of that informational flow, that storyline of buy, buy, buy. And I was able to, I think, to recognize that the story we were telling around particularly mortgage-backed securities and the underlying housing market in America was a story that had a fatal flaw. And we were able to recognize that fatal flaw pretty early on, and so we did really well in 08. So our hedge fund got pretty big. We were a little over $1 billion. And really, our returns flatlined from 09 onwards, like pretty much every other long short fund. We never lost money for our clients, something I'm still really proud of. So we ran that fund from 2005 to 2013, and we never lost money. But we weren't making money. We weren't making enough money to warrant fees that we're charging. I mean, if you're a hedge fund making single digits, what's the point? Really, what's the point? I mean, I get the point if you're a millennium or if you're running a low vol strategy and you're trying to be very steady Eddie like that, but that wasn't us. That's not most hedge funds. That's not the fun of the game playing in hedge fund land. So we gave all the money back in late 2012 going into 2013. And that gave me some freedom because, and I think you know this, Dean, I'm sure you know this. I mean, when you're managing other people's money, that has to be your end all and be all. There's no space for being right? There's no space for thinking bigger, deeper thoughts. You got to make some money for some people. So I started writing this blog. It was really just an email called Epsilon Theory. And the name comes from, again, econometrics. There's an epsilon term in all of our formulas in economics and investing. And in particular, we're all familiar with, what's your edge? That's your alpha right here, alpha exchange. That's where that comes from. And then we talk about beta, right? What you're essentially going along with markets. And in that formula, portfolio performance equals alpha plus beta, there's always another term that people forget about. It's an epsilon term. E for error. It's the stuff that's not explained by your models or by your process. And my strong belief is that there is structure in the error term. That's where our strategic interactions live as investors, what's often called behavioral economics. I think that kind of gives it a disservice because you talk about it as behavioral, it sounds like it's a pathology. These are the mistakes that investors make. And that's not quite right. These are the very human, rational patterns of behavior we have, and they don't fit neatly into fundamental factors for evaluating a security. They certainly don't fit neatly into portfolio characteristics for harvesting beta and the like. I think they're really a separate thing. Now, they can be a source of alpha. I think that's absolutely true. But the project of Epsilon Theory was to look at non-fundamentals, to look at behavior, to look at narrative, which I know we all talk about it today, but back in 2013 wasn't discussed widely, and really take those concepts seriously. And by seriously, I mean more than just kind of telling stories about them, but actually trying to measure narratives and stories and measure the impact that they have. So that was why I started writing Epsilon Theory. And that's gotten, we've got about 150,000 subscribers now to Epsilon Theory, all about word of mouth. So that's been really gratifying. And then so I did that for a few years, just trying to figure it out. Had the opportunity to start a new firm, a research firm, and that's what Perciant is. So we started that company in 2017. We called it Second Foundation Partners. We've changed the name to Perciant because that sounds better as a technology company. And that's what we are. I think we've developed some real science behind understanding the structure and unstructured data to understand how storytelling, the narratives we listen to and that we tell ourselves, really trying to understand how that can be a signal for understanding investment behavior. So that's the story, Dean.
Yeah, well, you go talk about the financial crisis, and in some of your writing, you talk about 2007, which was really the onset in a lot of ways. It was smoldering, but not yet burning, out of control. And you reference the just failure to really understand what was happening from a policymaker standpoint, right? You had the Bernankes and Paulsons of the world talking about subprime is contained, thinking that we had a sort of traditional potential slowdown in the economy at hand, and with all the data and all the expertise and all the PhDs, and really wanting to do their best, of course, on behalf of of the economy, just misreading the signals. And I find that to be for me, that's such a powerful example of, maybe the narratives. What's an asset price we look at and stare at every day is the VIX. Well, if the VIX is at 10 or 11 in early 2007, how much risk can there be? Right? The market is pricing this risk, and yet underneath the surface is this kind of tidal wave of systemic risk that's building and probably impossible to prevent from exploding, at that point. And so you get these imbalances of prices, and I'd love for you to just reflect a little bit more on that time period, because I've seen you write about it, that the asset price versus the reality of the risks. Markets do their best, but capital flows matter, carry matters. There's a lot of things that motivate these clearing prices, and sometimes they just get dislodged from the actual risks. I'd just love to hear you just talk a little bit more about that era for you, maybe '07 into '08.
And this is what I meant about why, there's sometimes in the history of an industry or the like where it's really helpful to be an outsider. Now, often that's not the case, right? Often the best way to succeed in an industry is to be immersed in it, to come up in that industry. And that's true for, I'll say, the two premier storytelling institutions of the last 150 years, and that's Hollywood and Wall Street. So Hollywood and Wall Street are both storytelling industries. Hollywood, overtly, they're telling stories. But Wall Street, the same thing. Every theme, every valuation, every multiple that's been put on a cash flow or any other metric. It's a story. It's a story. And I was an outsider to the story of mortgage-backed securities, which, outside of Fannie and Freddie. So this was a $10 trillion asset class by 2007. $10 trillion outside of Fannie and Freddie. The edifice of storytelling that has to be built over a period really of about a decade to build a $10 trillion asset class is just phenomenal. Right? So, and it's hard if you didn't experience it. And by experience it, I mean not just the collapse of the inverted pyramid where this entire $10 trillion structure was built on the assumption that it was impossible to have a nationwide decline in home prices. That's it. If you have a nationwide decline in home prices, the whole thing comes tumbling down, which seems crazy that you would build this sort of edifice on an assumption like that. But that's the power of money. That's the power of storytelling. And if you came into Wall Street, I don't know, 2000, say, I'll pick 2002. So you're coming out of the recession, the dot-com crash, and you're starting at wherever, Lehman or Deutsche Bank or wherever you're starting. You're immersed in this world of go, go, go for building this $10 trillion asset class. So it's the old adage, it's better to be lucky than good. The luck for me was being an outsider who came in as this $10 trillion asset class violated its core assumption. Now, like I said, there are a lot of smart people out there. And one of the problems, though, is that you start telling yourself the story. The problem is that you can't, it's not, for example, the ratings agencies were being, obtuse or being opaque in how they rated this tranche of that or that tranche of this. It was just written in a language that most people couldn't read. It was written in this language of econometrics and Gaussian copulas and the like. And I was lucky in that I was an outsider who could read that language and could identify that the entire edifice rested on that single assumption that it was impossible to have a nationwide decline in home prices. And once you started to see that occur, then if you're an outsider and you don't know, I'm supposed to give enormous deference to what the Fed chair says. Angelo Mozilla says it's going to be okay. Well, that's what's buttering my bread. So I'm going to say, yes, I guess he's right. As an outsider, I was able to say, well, the emperor has no clothes.
You mentioned, at the heart of it, there's two things, right? One is the mispricing of the allocation of credit to the individual borrowers. But the second and probably more profound mispricing was the correlation aspect, that all of these borrowers, there's a correlation underpinning this. As you say, home prices declining on a national basis. That's not accounted for, and that's a correlation event. And so one of the things, and I want to get to this at the end, you've talked a little bit about something that's really in my wheelhouse around equity correlation, being super low. Would you say that GFC is for you the most consequential in terms of helping you understand market fragility or vulnerabilities? Are there other events that might be worth highlighting for you that were, really impactful?
I think one of the things that's been really impactful for me over the last, 16 years now is not market fragility, but the way in which we've transformed capital markets into a political utility. And what I mean by that is the enormous strength of markets. I'll call it the political support that's available for deflationary shocks to markets. The most obvious example is, using the Federal Reserve to buy stuff. But I think more impactful, and this really gets to what I mean about how narratives change our world. What also happened in that time period was not just actual monetary support, actual liquidity support. And by the way, I'm not one of these guys that thinks that that's the wrong thing for a central bank to do. The central bank, the reason we have central banks is to be that lender of last resort. The reason a central bank exists is to provide money to buy when no one else will buy. So, look, QE1, I really think saved the world. It's that it became permanent QE. That's what I mean by turning something into a political utility. But I do mean more than that, because, and this is true, Bernanke himself talked about this, that it wasn't just the actual balance sheet operations, QE. It wasn't actually just ZERP, taking interest rates down to zero and keeping them there. The most important weapon they had in their arsenal was forward guidance. The most important weapon they had was using their words. So it was a very planned policy effort, as planned as, what we're going to add to the balance sheet and what duration we're going to put for what we're buying. It was a very planned policy operation to say words to try to get market participants to do certain things. And that overtness, right, to say, no, we are going to say things not because we believe them to be true necessarily, but we're going to say things in order to try to get a response out of you, the market participant. It worked. And this is what Bernanke said. It worked better than we ever thought it would. And in fact, by the end of Bernanke's term, he says, he said, QE2 I thought was kind of a wash. And he's saying this in his last public speech. QE3 and twist, he thinks were actually a little counterproductive. He said that for accomplishing our goals, though, forward guidance, using our words, it just exceeded our wildest dreams for how effective it would be. And Wall Street learns, right? Wall Street, again, in Hollywood, two very strong, they're storytelling organizations. The people who succeed in Hollywood and the people who succeed in Wall Street, they learn what works and they adapt to it quickly. So what you saw is, once the Fed showed the power of creating stories, of using narrative, everybody adopted it. Every CEO started to adopt a posture of, my job is to tell a good story, because that's what's going to drive a multiple. And you had, Mark Benioff is my poster child for this. Mark Benioff was brilliant at this, absolutely brilliant. I mean, Salesforce didn't actually have any profits. They've got a business model, frankly, where they, at least in the time period I'm talking about, they can't make a profit. It's structurally impossible to have a GAAP profit with the business model that Salesforce had. But it didn't matter, because Mark Benioff could create a pro forma metric and tell a story over which he had some control to create the, not illusion. I mean, the numbers he described were real numbers, but they were made up numbers to describe a particular vision for what a company should be trying to achieve. Not profits, but, pro forma adjusted revenue growth. It's it's all it's all it's all fine, but it's storytelling. And this is what took over the world, is the storytelling. And that's what I've been trying to figure out. What are the patterns of storytelling, both so we can see it and maintain some critical distance. I'm not telling you to short Salesforce. What I'm telling you is that it's when Mark Benioff is up there talking, that's when you want to buy it, because he's a great storyteller.
Reminds me, perhaps the greatest storyteller of our era right now is Michael Saylor. Um, Not many people better at creating the fear of missing out in crypto.
Great example, right? So he's created this. It's very Benioff-ish to create this bullshit metric of Bitcoin yield. Yeah, strategy, is that what we're supposed to call it? Strategy. It's a closed-end fund, right? That's what it is, and I wish it were regulated as such, but whatever, fine. I'm not frustrated. I'm not frustrated by it, Dean, but because you're absolutely right. He's a very good storyteller. Not the first time.
I think one of the things that on this front, and I want to kind of dive into some of your written work, which I really have enjoyed going through. I think there is no story to tell without the price. Price is the ultimate "I told you so," right? Good, bad, or otherwise. Price reinforces his ability to sell that narrative. Without the price, the narrative is going to really get hurt. It's going to be very difficult for him to create the fear of missing out without the reinforcement of price. Same thing was true in the ultra low vol era of 2005 and 6. The Fed thinking this is a conquest of central banking. We've created the great moderation by dispersing credit risk around the system, and all you have to look at is, look at the IG, it's trading at 22 basis points, or look at the VIX, it's at 10. So price, really reinforces how we think. I wanted to just kind of dive into this, some of your writing in the piece you put out called The Great Ravine. And so, simply put, you say the end of the era of both cheap money and trust is here. And I think that was just very provocative. I mean, obviously, the cheap money side, you don't have to look very far. I think it's 5 years ago, right around this time, the 30-year was yielding 1.2%. Forget about the 10-year. 30-year money was on offer at 1.2%. A market clearing price with lots of liquidity behind it, right? It's a real price. So I'd love for you to just talk about that. And then the trust part, are they related? Is the breakdown of trust a function of more expensive money? Are these independent? But I'll just ask you to, tell us how you've framed this out and maybe what the implications are for you.
Let me start with the last one first, about the breakdown in trust. And because it goes with what I was talking about storytelling before. So, and again, this isn't a secret. This is Bernanke's fessing up, right? It's like in the movie The Big Short. They're not confessing; they're bragging. And so he's very explicit about this when he says, "We used our words not because we necessarily thought they were true, but we used our words to try to get a behavioral change in market participants." We have a word for that when we say you're using your words to try to get somebody to do something. That you're using your words not because they're true, but because you're trying to get them to do something. We call that lying. we call that lying. And that approach to the world, that everyone could be nudged if you just use the right words, spread like wildfire throughout every aspect of our society. I mentioned Hollywood and Wall Street being great storytellers. The other great storytelling center of our modern world is Washington, D.C. So it wasn't just Fed governors, it wasn't just CEOs, it wasn't just cultural leaders, it was also every politician and every bureaucrat started using their words not for the purpose of communicating a truth or for communicating what they actually believed, but using their words to achieve some desired behavioral end. This became the era of nudge, to nudge you in your vote, to nudge you in your investments, to nudge you in your purchasing. This became the era of, oh, it's good to take on more debt. You should absolutely do that. Oh, it's good to put yourself into some sort of echo chamber bubble. It's good to, have your iPhone on be looking at that screen 8 hours of the day. This all happened at the same time, where we became so immersed in the messaging, where we voluntarily adopted a device that gives us messages all the time, constantly, giving us messages not of what people actually think, but of messages designed to lie to us. I think COVID was a big part of that, where the messaging was designed to get behavior changed, not to actually prevent deaths or the like. But COVID was a big part of it. What's happened in our economy, what's happened in our politics, we've been lied to, all under the guise of spinning a narrative. And ultimately, yes, it yields a lack of trust, and it just yields a nihilism. It just yields there is no truth, and the ground is not steady beneath our feet.
Are there market implications as you talk about? And I think you did link this, to certainly the tariff tantrum that occurred. Obviously, a VIX up event, but also a Treasuries up and yield event. Never something you want to see. Kind of a reverse diversification from the bond market, right? It became a source of instability rather than the place people flock to protect themselves. Is there a risk premium in the Treasury market that's associated with this lack of this breakdown in trust?
Oh, of course there is. Of course there is. And risk premium in the Treasury market is kind of our fudge factor. When we just kind of say, well, it's when you look at the long end of the curve and how what's the yield on the 10-year beyond your expected inflation rate? Well, that's risk premium. And it's absolutely going up. It's absolutely going to go up more. And it's absolutely coming from this lack of trust, because part of that squandering of trust has been absolutely on the fiscal side of our world. Neither party has any desire nor ability to change the shape of our fiscal policy. In particular, neither party has any inkling of desire or power to reconnect taxation with spending. So those two functions have been the meaning of taxation and spending and their connection has been totally severed. Right? Taxation is now, the meaning of taxation is an instrument for justice, whatever that means to the party in power. The meaning of spending is stimulus, whatever that means to the party in power. So there's no connection between taxation and spending. That core, I think the most important story we've got, that taxation and spending should be connected, that story is broken and it's been replaced by news stories: taxation for justice, spending for stimulus.
How do you see this playing out? I thought, one of the main features of the big beautiful bill was the debt ceiling being allocated up to 41 trillion. So they got themselves $5 trillion of space, which is probably going to last two odd years, right? At the current pace of a 6 to 7% fiscal deficit, which is 3% just interest costs. Um, trying to think about the market implications for these things. How do you see the just from a rate side, from a dollar side, from an equity side, um, and a lot of this again back to the Big Short, right? Those folks are mentioned in that book. They're the stars of the book because not a lot of people did get it right. Maybe that's because they were outsiders. The Cornwall Capitals, featured as, I think they called them Brownstein Capital in the book. They were outsiders, so they got to look at this insanity and the prices associated with being able to buy protection in a way that others couldn't. Um, but timing these things is very difficult. How do you think about positioning for that vulnerability?
Yeah. Well, look, I'm a short seller at heart. That's because I am that outsider. It's just the way I'm wired, and that's what I did well in our hedge fund. And the problem, of course, with being short, with seeing the flaw in things, is that if you're early, you're wrong. And people try to excuse that or say, well, but that's it's not. No, you're just wrong. You're just wrong. so, so, so being a short seller, and this is why most short sellers, and why I'm so happy to be out of the hedge fund business, you become a real curmudgeon because you're right, but until you're right, you're wrong, and you're constantly flowing against the flow of information for buy, for number go up. So there's nothing more difficult, either psychologically or frankly in terms of investment strategy, than to be short. So I've kind of got a couple of different answers. One for people who have the psychological and mostly the psychological makeup, not the business model where they can actually be short. But I also want to talk to the long only audience here, because that's I suspect most of the audience. And in fact, let me talk about that first. So there's, for wealth management, for a family, for yourself, for that long-term perspective, there's really only one question you have to get roughly correct. You don't even have to get it precisely correct. There's only one question you've got to get roughly correct, and that's the question of inflation. That's it. If you can just get that question roughly correct, you're going to be fine. You will be able to preserve and grow your and your family's wealth over time. If you get that question wrong, you will lose. So for a long-only investor, it's trying to time things to a T is almost always a mistake. It really is. Maybe you'll be lucky, but it's almost always a mistake. What you've got to get right is that core question. Where are we? Is this an inflationary world or a deflationary world? And my friends, we are in an inflationary world. We're in an inflationary world. And so if you have that mindset, if you understand that, then you're going to be fine. You can find beta, right? You can find assets, and you're going to be okay. But you have to recognize that. So now getting into kind of the more, I'll call it a trading orientation, where you're able to be short something, where you have the psychological makeup to say, oh, I think something's going to go down. Look, the dollar is going to go down. The long end of the curve in the US is going to go up. The risk premia associated with poor government, a government that whose fiscal house is who can't be fixed and has no intention of fixing it, that has these long-term consequences. And that's not me being a grumpy grandpa saying that. This is what happens. We're in a situation where the story will be that we're going to grow our way out of it. My strong belief is that we're in a position where we can't grow our way out of it. The effort will be to try to pretend that nominal growth, i.e. real growth plus inflation, is just real growth. That's why I think that the outcome of the recent issues over the Bureau of Labor Statistics, the jobs numbers, will have the same thing happen over inflation numbers, will be that we'll say that this is going to be powered by AI and we're going to model what the numbers are to try to present a cartoon that inflation is lower than it actually is and that growth is higher than it actually is. I promise you that's what's coming down the pike from all of this. The reality, though, is that we're in an inflationary environment and we're in a low growth environment. That I believe very strongly. And so that's going to lead to some things going down, right? Ultimately, it leads to the dollar losing that value that it can keep, that you're not getting enough from, you're not getting a high enough rate of return on the dollar to stay in the dollar. And that has very specific consequences and ways where you can set up short positions where you're not getting whipsawed and where you can stay in the position for a longer period of time. So that's what I've got to say about that, Dean.
One of the areas we talked about a little bit earlier was just on credit correlation before the GFC. And in some of your writing, I saw you reflect the realized correlation among stocks in the S&P, which is something I look at, each and every day, and it's just mind-numbingly low. And one of the things about option prices is they really just simply are a function of whether realized volatility is high or low. When it's high, you can pay for options and delta hedge them and spin off some profits. When it's low, you really can't do that, so you got to pay a lot less for the options. You look at the lowest VIX levels, they're going to absolutely coincide with the lowest level of realized volatility. And the same things for correlation. So this really low level of realized correlation is bringing this incredibly low level of implied correlation. And so my sort of where I'd love for you to talk through, and I know we'll talk about Perciant as well in this context, is, you've got this giant force called AI capex, and they're spending a ton of money, all of them together. They're realizing lots of profits. They're sort of eating the entire S&P, 40% in the top 10 stocks. And yet, even as they seem engaged in a very much the same pursuit, capex, they're vastly uncorrelated. I looked at the correlation between Google and Microsoft, and it's 7% over the last 2 months. That's ungodly in terms of how low that is. You go back to the original tech bubble, Intel to Cisco was a 75, 80% correlation. And so I'm wondering how you think about that correlation, and especially against all of what you know about and are doing in the space of generative AI. Are we missing something there in terms of how low these stocks are correlated? Is that a blind spot for the market, or they're just going about their business and they're not really overlapping?
I think a couple of things here, Dean. I think that, first of all, we've built a tech company here, and using generative AI has been a transformative thing for our company. We're getting 100, 200x improvement. I'll say they get 100 to 200x improvement in our core processes by basically using LLMs as an operating system, to constraining them very heavily and just using them really as a linguistic calculator, what we call a semantic search and the like. So I'm not just a believer in the transformative productivity enhancement power of AI. I'm a participant, right? It's absolutely real. And that's why I actually believe that the AI capex story, as chastening as it is, right? As because you look at it and you think, well, this can't possibly work. It doesn't have to work, right? So one of the first things I learned is that large cap tech, all tech, it speaks the language of growth. It speaks the language of growth. Talking about a tech value company, it's almost an oxymoron. And I say that knowing that, these tech companies have more cash than God, right? It's crazy how much cash they have. For a tech story to work, it has, though, to speak the language of growth. And by spending on generative AI, they are speaking the language of growth. So what I'm telling you, Dean, is that as much as a value investor can look at the AI capex magnitude and say, oh my God, this is going to end in tears, and you may be right, that story is not going to crack this market. That story is not going to crack this market because you can never disprove a story of growth. It's just hasn't happened yet. Right? So that story is actually one of the main supporters of this market continuing to go up and volatility to go down. Even as, if you're approaching this from a value perspective, you're looking at and saying, oh my God, what is going on? I think the story that actually can provide a crack in this market gets back to what I was saying about the story that Washington wants to tell and the story that someone who wants to preserve their wealth has to get right. And that's the story about inflation. You can pretend, you can jawbone, you can do all you want out of Wall Street and out of Washington. Investors, owners of wealth, when inflation starts to pick up, and we are picking up here, that is what will crack this market. That's what will crack the market.
I mean, certainly you've got, what, 5-ish cuts priced into the end of 2026. If clearly the market is expecting Powell to get going, but if these tariffs start to get passed through even a little bit, I mean, we've already stopped making progress on core PCE. That's been stuck for a year now. So I wonder.
And it's not just tariffs, right? I mean, the bigger thing to me is to look at the labor market, right? So we've got an incredible tightening in the labor market because anyone who's ICE adjacent is just removing themselves from the workforce. So you've got, if you held labor force participation constant, we'd be at 4.9% unemployment. But at the same time, wages are going up sharply. We're at 3.9% now, year over year, wage growth. So we're at the early stage of a classic wage price inflationary impetus. We just are. You know, to the degree that tariffs, so far, what's happened with tariffs is they've been eaten by corporations. GM is your poster child for that. They're not going to eat it forever. And you're already seeing it starting to get, passed through, especially in goods. So this is all happening. It's all going to happen over the next few months. And Q4 is going to be this stagflationary rock in a hard place where, yes, the Fed will almost certainly cut and the 10-year will go up higher, right? Getting back to your risk premium question. This is the future we've got ahead of us. You can't hide it. You can jawbone it and you can BS it for a long time. But ultimately, this is the story that capital owners really care about, because the story they've got to get right is the story about inflation. And as inflation is not cured and starts to go back up again, that's what cracks the market. And that's what drives the vol. And then you'll start seeing it'll be like in 22 where the correlations of those tech companies go back up really high because they're going to trade together at that time. But it's not the AI capex story. That's a story of growth. There'll always be an audience for that. It's the inflation story that's out there that can crack this market.
Well, I would love to learn a little bit about Percient. I saw some of the charts that were included in your notes, and I just find I'll let you describe it and maybe give us a couple of examples, but the ability to translate text into some sort of time series that's got meaning to it, I find really compelling. And I saw some of your work on looking at the extent to which various safe havens were still considered safe havens with gold, the Japanese yen, and through that tariff period where the treasury market was a little unstable, it basically not being mentioned as frequently as a good old safe haven. Talk to us just about the company and kind of what a client would look like and how they would use the work that Percient is able to produce.
Sure. Well, and look, I think anyone can avail themselves of this. I mean, we write about it a ton. So, yes, we have clients where you're able to actually design your own, we call them storyboards, not dashboards, but storyboards, where you're able to, for whatever it is that you care about, gold, LNG, AI capex is a great example, right? We can actually track the story over time and today because we can read everything in the world. So everything that gets published, we pull in overnight, and then we read it for meaning. It's not asking AI to give you a summary of things, right? That's the worst thing you want to do. It's why it's so useless to have AI say, "Give me a summary of my emails." It guesses at what will be useful to you, and it always gets it wrong. That's not what this is about. What this is about is starting with humans, with experts saying these are the stories in a particular field that we want to track, and then we track them. We see which stories are waxing, which ones are waning. We can measure it. You can see its impact on prices, on behavior. It's pretty wild, Dean. It really is. It's this invisible world that we know is around us. We know that there's a lot more to narrative than sentiment, right? Are you using mean words or nice words? There's so much more to it than topic clustering. What's the Google search on this term? Or how often did CEOs reference this term in their earnings reports? No, what's really important is what's the story?
Is there an early detection system around, again, back to the GFC, the disconnect between the asset price, the risk metrics, credit spreads, VIX, and then the contagion at the center of the system, and then maybe the whistling past the graveyard, Fed not really understanding the systemic risk? Is there something that you see as not predictive, but getting out in front of emerging issues or threats?
I think that it's a mistake to think you're going to create a crystal ball that's going to predict some future policy or the like. That's not what this is. What this is I call it nowcasting. Why are people behaving the way they are? And it's not backwards looking. It's not looking at like our macroeconomic releases are all backwards looking. They have to be. This is now. This is what is being said to you today, all of it, and seeing which stories, some of which may have been dormant for 10 years, are now starting to come back up. Which stories have been very loud are now starting to diminish in volume. It's understanding that gives you the timing for when you can go short, that gives you the timing for when you want to change an allocation. It's not a crystal ball. It's the ability to see through the headlines and see what's actually happening that's driving behavior. That's what it is. And it's anyway, it's wonderfully cool stuff. It's best seen with some examples, and come to Perciant.com and we'll be happy to show you some examples. Or Epsilon Theory. That's where most people, I think, know me from. So we've got lots of case studies and we write about all this very much there.
Well, Ben, it's been a pleasure to host this conversation. I've really enjoyed. I think we scratched the surface on just some of your thinking, but I think it was a really productive hour. So I really appreciate you taking the time.
Great to be here, Dean. Thanks again for having me.